Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Hey, this is Stan the Annuity Man. I'm America's annuity agent, licensed in all 50 states. That includes yours. So we would love to have you as a client if you're not already one and listening to this podcast. If you are, thank you. Today's topic is how annuity companies make money on your annuity. There's a lot of misinformation around this topic. I mean, I hear all kinds of stuff, especially when it comes to indexed annuities where there's an index call option that has a limitation on the upside, lack of a better phrase. And the index annuities were put on the planet in 1995 to compete with CD returns, and that's pretty much what they do, even though that's not how they're sold many times, in many cases. They're sold as too good to be true market products. They're not. They're life insurance products. They're not securities. But a lot of people are under the assumption that you buy this index call option, you have this index call option within your indexed annuity, and there's a limitation on the upside. So the logical thought progression, I guess, if you're a consumer, is that the annuity company, the evil annuity company, keeps the balance, which is absolutely 100% untrue, false, bang. I actually did a YouTube video on this topic, which I would recommend you going and listening to. I have a YouTube channel, Stan the Annuity Man YouTube channel. If you go to YouTube and just type in Stan the Annuity Man, you'll see all my videos pop up. I do one per day, Monday through Friday, a new one. But one of them I did was how annuity companies, make money or keep your money or use your money with fixed indexed annuities, which is what I just talked about. So that doesn't happen. I mean, there's no games being played. The annuity industry is highly regulated. I mean, highly regulated. Now, fixed annuities are regulated at the state level. Variable annuities are regulated by FINRA. It's a security. So, just like a stock and a bond and ETFs, mutual funds, same regulation applies to variable annuities because that's a security, not a fixed product. And then, charitable gift annuities are regulated by, I guess, there's the American Association of Charitable Gift Annuities, et cetera. There's those governing bodies that oversee that, but that's not a commercial product. You can get those from your charity, 501c3, et cetera, university, those people. But I digress. So, how do they make money? How do annuity companies make money on your annuity? First of all, like I said, they're very, very regulated. With banks, if you give money to a bank, they can take the vast majority of that money and then go loan it out, and they have to keep a certain small percentage at the bank, etc. With fixed annuities, day one, they have to have 100% of your money on hand, and they have to have it in investment-grade bonds. Now, I know you tinfoil hatters out there, you conspiracy theorists, are shooting down that investment-grade part, but, that's as good as it gets. If you don't think treasuries are safe, then we're in anarchy, okay? And I know the debt situation of the country and all. I get it. I understand. I'm Stan the Annuity Man. I get it. But annuity companies aren't smarter than banks. They're just more regulated than banks. So from a safety standpoint, they have to keep all your money on hand. They're buying current interest rate bonds within their portfolio. They have bonds, what I call Jimmy Carter type bonds. They have bonds from way back in the day. They got an old type bond portfolio. So the bond portfolio is spread out, and I'm assuming laddered with most. And I do have a background with Morgan Stanley, UBS, Payne Weber, Dean Witter. I've done that stuff. So I understand bonds. And sometimes I peek in to their records and look at what they're doing. And again, highly regulated. So they have old bonds, new bonds. And the other thing too, so they're making money on that. And the other thing too is they can buy institutional type investment grade fixed instruments that me and you as individuals cannot buy. So they do that as well. But let's talk about making money on, let's say you bought a fixed annuity, like a multi-year guarantee annuity, which is a fixed rate annuity, the annuity industry's version of a CD, or a fixed indexed annuity. They're taking your money, they're making money off the bonds that they have that they're invested in, and then they keep a portion of that and then give the rest back to you, either on an interest rate or a little bit more complicated on the indexed annuity side. But the bottom line is they keep some and give you some, right? So that's how that works. And you say, well, that doesn't sound like a lot. Well, we're talking about billions of dollars too. I mean, we're talking about lots of money. Now, how annuity companies make money with lifetime income products, which most annuities solve for lifetime income. They were put on the planet. Annuities originated in the Roman times when the Roman Empire created annuas. A-N-N-U-A is Latin word for payment. They created those payments for the dutiful Roman soldiers and their families. That's the genesis of the single premium immediate annuity. That's in essence what it is. And it's been sold in this country forever. But getting back to the point, how do annuity companies make money on that immediate annuity or deferred income annuity or qualified longevity annuity contract or lifetime income benefit rider? Any type of annuity like that, income benefit rider is an attachment, but any type of lifetime income guarantee that's contractual, that price that they're paying you monthly, that guaranteed income stream, is primarily based on your life expectancy at the time you take the payment. Or if it's joint life expectancies, plural, at the time you take the payment. Interest rates play a secondary role. I'm going to repeat that again. With lifetime income guaranteed products, interest rates play a secondary role. And the reason I'm getting a little loud with that is I keep getting calls. I'll get calls like this till the cows come home. Southern expression. That, hey Stan, I'm going to wait and just, I'm going to wait till rates go up until I buy that immediate annuity. It's like, hey Fred, are you going to factor in the payments that you missed while you're trying to time things? Because it's all about life expectancy. By the way, works just like Social Security. The older you are, the higher the payment. The older you are, the higher the payment, because the less your life expectancy, which means that there's fewer payments, which means that the payments will be higher. So how do annuity companies make money on your annuity? In a lifetime income payment situation, they're giving your money back while they're holding on to the rest of it. All lifetime income payments are a combination of return of principal plus interest. So they're doling back your money based upon your life expectancy. So they're doling it back over time, and it's a guaranteed issue product. So they're taking all of you at your age, lumping everybody together, knowing that some of you are going to live a long time, some of you aren't going to live long at all, and some of you are going to live right on the money to your life expectancy. Someone asked me the other day, they say, Stan, you always say, annuity companies have the big buildings for a reason. I always say annuity companies have the big buildings for a reason, or they have the large logo on their jets for a reason. And the reason I say that is they don't give anything away. Life insurance companies know when we're going to die, so they price things accordingly. Property and casualty companies don't have the big buildings for a reason in most cases, because they don't know when the hurricane's going to hit, or the tornado's going to hit, or the fire's going to happen. Life insurance companies know when we're going to die, and fixed annuities are issued by life insurance companies. Variable annuities are issued by life insurance companies. So when you're buying a lifetime income guarantee type annuity, they're holding on to your money. They're making money, not tons, bond type returns off your money, because they have to keep it in investment grade products. And then they're doling the money back to you based on your life expectancy. They're doling back to you over time. Does that make sense? Should. That's how they do it. And they just do it with large amounts of money. What do they say? The eighth wonder of the world is compound interest. So when you're having compound interest on hundreds and hundreds and hundreds of millions of dollars, billions of dollars, etc., things work. Math works, right? And that's life insurance companies in a nutshell, annuity companies in a nutshell. And most of the products that people are buying are life expectancy type products. Now, they really like it when you buy an annuity and then just defer and don't touch it. because they're holding on to your money. Now, internally, there could be some guarantees that they have to match, obviously, and contractually guarantee, but they're holding on to your money. So anytime an annuity company's holding on to your money, they're making money off investment grade paper while they hold on to it, or if it's life expectancy, while they pay it back to you. Now, another question I get a lot is, well, why did this variable annuity or indexed annuity or multi-year guarantee annuity, which is a fixed rate annuity like a CD, why did these have such high interest rates? I mean, such high surrender charges. My apologies. Such high surrender charges. Why? Well, the reason is, number one, the annuity companies have to lock in the guarantees because they're contracts. There's guarantees within the contract they have to lock in, so it can't be 100% liquid. Secondly, annuity products pay a commission to the writing agent, like me, Stan the Annuity Man. So there's commissions paid. And so if you get out of your annuity contract early and have to pay a surrender charge back to the company to get out, that's there to also try and cover those commissions that were paid to the agent. So the reason I bring that up, the reason I talk about surrender charges within deferred annuities like multi-year guarantee annuities, fixed rate annuities, fixed index annuities, variable annuities, is that annuity companies are smart, okay? They are not going to lose if you just pivot and change your mind midstream from what you originally decided to lock in. So in other words, if you bought a 10-year surrender charge annuity in year 5, you said, I don't want to do that anymore, give me my money, and you agreed to pay the surrender charge, the annuity company's like, okay, we're just going to take the surrender charge money and try to cover our expenses of what we were trying to do, what you initially agreed upon. So that's kind of that angle as well. And people always say, well, they can make money on my annuity and they're solid. You know, how safe are they? How safe are the annuity companies? Well, you know, we look at 4 rating services, AM Best, Moody's, Standard & Poor's, and Fitch, and we have on our site at theannuityman.com under resources, we give away for free the Comdex rankings, which is a compilation of those 4 rating services. And then they have a formula that they score the annuity company from 1 to 100, 100 being perfect. So I always love that because, you know, the ratings A or AA or A++ or A minus or A, I mean, that's great. We kind of get what that means, but I like Comdex because it takes the 4 rating services, AM Best, Moody's, Standard & Poor's, and Fitch, and then says, okay, this carries 100, or this carries 82, or this carries 97. Is it perfect? No, it's not perfect, but it's a very good thing to look at from the standpoint of safety and how they're making money on the annuity from the standpoint of, hey, is my stuff safe? Can they back up the claims? Another thing you can do too is if you're looking at an annuity with us and you want to see more detailed financials, we can get that to you. We have the resources and the relationships with companies that track that to get whatever you need, whatever balance sheet type stuff that you need to see, we can get it to you. But I do have a fiduciary responsibility that I take very seriously to recommend companies that I do think have the claims paying ability to back things up. The only thing I cannot prevent is somebody like a Bernie Madoff cooking the books. I mean, none of us out here can. We have to believe what's being, put down on paper. And honestly, that's on the regulators. That's the reason regulators are in place, is to make sure that doesn't happen. But, ever since the Madoff thing, we're all like, okay, we really want to trust it. A lot of people will say, hey, they mentioned a company that was, I'm not going to mention their name, but they were part of the whole 2008 debacle. But the bottom line is that company's annuity and life insurance side was the rock of Gibraltar that kept them alive. It was the derivative side of them that was really hurt. And you probably know who they are. I just don't need to talk about them like that because I respect who they are and they've done a good job. And the annuity and life insurance people better be getting the head table at all the functions because they save that place. So how do annuities make money on your annuity? They buy investment grade bonds, they hold on to your money, or they dole it back to you over your life expectancy. It's really that simple. From a baseball analogy, they're just hitting bunt singles. They might hit a bunt single and then they hit a single. They're not swinging for the fences. They're not looking for double-digit returns. Just by law and regulation, they can't. They're not allowed to. So they're very good at hitting bunt singles. And they're very good at not getting into trouble. That doesn't mean that some do or some don't. But the other thing from a safety standpoint that I always tell people is that what I like about the annuity industry, and the annuity industry doesn't like it when I talk about this, but I think it's true. Annuities are confidence products, meaning that if my mom, who's age 80 in St. Augustine, Florida, doesn't get an annuity payment, it's over. She's on the nightly news and it's game over for the industry because she's going to squall like a pig. She's going to go crazy. And she should. So what happens is, I call it the annuity mafia, is the annuity companies kind of oversee each other, and the big ones are not going to let some yahoo mess things up. They're going to come in and swoop up the assets and buy the company, and everything's going to be beautiful, and the rainbows are going to set over the sunset, and the unicorns will chase the butterflies. So, when you're looking at a transfer risk contract, because annuities are contracts, they're transfer risk contracts that solve for specific things, primarily 4 things: principal protection, income for life, legacy, and long-term care. That acronym is PIL. That's what they solve for: long-term care, confinement care. And they're commodity products. You should shop all carriers for the highest contractual guarantee that you're trying to solve for that fits your specific situation. And you only own annuities for their contractual guarantees, what they will do, not what they might do. And if you stick with that and do your due diligence on the ratings and the Comdex score, you're going to be fine. But I hope I've covered on how annuity companies make money on your annuity. If you think logically about it, it makes total sense. And it begs the question, why don't me and you start an annuity company or life insurance company? First of all, it takes a lot of money to do that. But if you have a couple $100 million laying around, it's not a bad business plan, because what did I say in the first part of the podcast? Annuity companies know when we're going to die. Life insurance companies know when we're going to die. They just price things accordingly. So if you're getting a lifetime income stream product, they're going to price that payment based on your life expectancy, period, and hold on to the rest of the money as they're doling it back to you. Because remember, all lifetime income payments are a combination of return of principal plus interest. You're getting your money back with interest. And so people will slap their head and go, what? What's the good news about that, Stan the Annuity Man, Mr. Transfer of Risk? The good news is they're on the hook to pay even if the account's at zero. They're on the hook to pay regardless of how long you live. And annuities are the only product that does that in the financial world. It's a monopoly. It is an actual monopoly that they have that they don't pound the table and tell people about, which is kind of interesting. I digress, but that's what that's what I talk about, is that's what these products are for. There's no ROI until you die. So you should be looking at annuities as pension products. Just like you don't look at your Social Security and go, I wonder what the return on investment is going to be on that. You don't. Or your pension, if you're so fortunate to have one. You don't say, I wonder what the return on investment. You don't. You just like the income stream coming in. Okay. That's kind of where annuities need to fit, most of them. There are some deferred annuities. We talked about that on how they make money on deferred annuities. They're holding on to your money. They're giving you back the contractual guarantee that they promised within the contract, and they're keeping a little bit extra of what they're getting from the standpoint of the investment grade bonds. It's really that simple. Bunt singles, right? Baseball analogy. That's just a bunt single. So I hope I have answered that question. I've gotten so many of these questions, I said I finally have to do a podcast on it to cover it. But if you think logically about it, that's how it all works. Annuity companies aren't smarter than banks. They're just more regulated than banks. And that's the reason that, in my opinion, they are, in most cases, safer than banks. I know they're going to get some blowback on that, but hey, facts are facts, right? And that's the way I feel. So with that, I appreciate you listening to Fun with Annuities. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 annuity owner's manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.